Once again, ladies and gentlemen, a very beautiful evening and welcome to UOB Privileged Conversations Riding Emerging Tailwinds. Please join me to welcome Head Regional and Singapore Wealth Management of United Overseas Bank, Ms. Cheng Shawby, to say a few words.
Good evening, everyone. A very good evening to our esteemed clients of UOB, our business partners, our distinguished speakers. I'd like to extend a very warm welcome to all of you to our 2018 Privileged Conversation, Riding Emerging Tailwinds. I remember last year, at the same time, if you all remember these phrases, we started 2017 with a theme, 山重水复疑无路 柳暗花明又一春. It was a tumultuous 2016, I remember, and it ended on a good note. The optimism at the end of 2016 allowed us to actually become more confident and more optimistic. And hence, the 2017 theme of 山重水复疑无路 pans out very well because really it was 柳暗花明又一春. 2017 was a great year. If you recall 2017, positive, optimistic developments actually pan out, be it synchronized economic expansions across the world, the reduced political headwinds in US, in Europe, and even the consolidation of leadership for China, the continuation of leadership in Japan actually gave us a lot more confidence in the markets. It fueled a lot of rally across asset classes, and if you have invested in 2017, I believe you are happy because you have made money. If you look across 2017, the asset classes delivered good results. Amongst all, equities had the best double-digit return. Easily, more than 20%. Fixed income, while challenging, actually also had a good return in terms of a high single digit. In fact, if you recall 2017, commodity prices actually came back. And even gold and oil saw more than 10% return. Maybe for those who were trying to buy dollar or had dollar, you probably went down about almost 10%. But if you remember 2016, when Trump took the post of the president, there were a lot of hope, a lot of confidence that came, and actually dollar rallied at the end of 2016. And as the year started 2017, there were a lot more uncertainty, question marks on Trump's policies, administration, and that actually took a bit of the strength of dollar back. And importantly, if you look at 2017, again, the economy that actually expanded across actually lended a lot of strength to the other currencies as well. And hence, it took a bit of returns away from the US dollar. But overall, 2017 was a very good scorecard. So I hope all of you are great investors, are happy investors. And more importantly, I'd like to point you to the first bar of multi-assets. Multi-asset has always been our core philosophy and core strategy for our clients because it transcends cross-asset classes and it rides the different volatility across the different asset classes and across the cycle. And it has also delivered decent and respectable return for our investors. So after an exuberant 2017, what do we think 2018 would bring? I think this is why all of us are here, to listen to more insights. I will not steal the thunder from the speakers. But in summary, what we see really, I think we believe that the continuation of the economic growth will be there, be it in the developing markets, be it the emerging markets, that will continue to lend the tailwind into 2018. And you will probably see a lot more other countries and economies playing catch-up with that. Slowly, you would see other countries or central banks slowly hiking, but we don't believe that you will actually be at an accelerated pace, given that we believe inflation will actually continue to be benign. So 2018 looks like a good macro, but as in with all investments, we should also be cognizant of the risks. Where do we see headwinds in 2018? One, inflation could possibly overshoot. Markets could be underpricing inflation. If you look at it, good growth, better wages, tighter labor markets, recovering commodity prices. These are possible drivers to an inflation overshoot situation. Of course, we are concerned about China's possible hard landing. This could possibly come only if we think that the government choose to be overly aggressive in their policy, which is not our base case. But geopolitical risk has become almost a hygiene consideration when we invest. It is part of the risk that we take when we actually start looking at our investments, be it Middle East, be it North Korea. That is something that we should also be mindful of. And of course, the fourth risk that we see is possible central bank missteps, be it overly quick in changing monetary policy. That will be something that we will watch for in 2018. So understanding the macro and where the possible risk could stem from, tonight is the night that you find out where we will advise you to put your money. Okay? We actually see opportunities across the three asset classes. In equities, we actually do see it to continue to be our preferred asset class. But where? I will leave it to the panel and able to share with you. Fixed income, I think credit still have a place to go. Again, I won't reveal too much. I'll leave it to the panel. And FX, we do think that dollar may remain pressured near term, but that said, because currency play, the other side will equal to opportunity. So these three asset classes will be something that I'd like the audience to really pay attention to the panel later, and you can see where you can actually suss out and where you want to place your money. After asking yourself where to place money, at UOB, we are particular about how to place money. Today, if you walk out to your other banker, if you have other banker and not UOB banker, the traditional approach they will tell you is, Mr. Customer, you are an aggressive investor. Let me advise you. You should put 85% of your money in equities and 15% in bonds. Take a step back. Is this a relevant advice? Is it still enough? We don't believe so. And I share with you why. If you look back at this advice was really based on the theory called the modern portfolio theory. In the past, when academics, practitioners look at how the capital markets behave, how asset classes behave over time, how are they correlated with each other over time, they came up with an efficient frontier. How much in equities, how much in bonds, what would be the risk-return profile looking like? But is that the best way to invest your money? I would say no. One, is the theory still relevant today? Just a decade ago, 2008 September, when Lehman Brothers collapsed, you realize that all the central banks stepped in with huge liquidity. Unprecedented policies became very, very loose, huge liquidity, extended periods of low interest rate environment. And you start to realize when you look back, asset classes' behavior has started to take a change. Equities and bonds were doing well. This is actually quite different from the old capital markets behavior. And to me, therefore, this is actually a point of insufficient as a single investment approach. Second, we have become a lot more affluent across the globe. What does it mean? Life expectancies have actually increased. So it does tell us that the risk of us outliving our assets has become very real. Investing just based on equities and bonds allocation is not enough. We need an investment portfolio that helps us generate sustainable income so that we can manage the longevity risks. Third point, if you look at our financial goal, when we think about financial goal, we think about, oh, I want to retire. Oh, I want to send my children for an overseas education. But is this equating to a risk return by investing 85% in equities and bonds? It's not enough. So what do I conclude from here? The portfolio theory is no longer enough. So at UOB, we advise on a different way. I think I shared with some of you who were here previously, UOB takes a risk-first approach. A lot of our methodology and advisory are built on taking a risk perspective when we advise our clients. We don't believe in just taking equities and bonds and give it to you as allocation. When you come to our bank, we actually look at, okay, Mr. Customer, what is your goal for investing? And after tonight, you'll be very excited because Abel and the panel are going to share with you what are the opportunities we're going to see in 2018. But for us, we will tell you, similarly, Mr. Customer, you're aggressive. I will advise you, not more than 40% of your money, you should be investing in tactical opportunity. Why does UOB take such an approach? Because we want to ensure that you have put aside sufficient money to safeguard your assets and build sustainable income generating capacity in your investment portfolio while taking risks to participate in tactical strategy. And hence, you look at the bar, it's a bit different. 60% core strategy, 40% tactical strategy. It is beyond the asset class allocation only methodology. So we are proud of our risk-first approach and do speak to your client advisors for more details. And finally, 2018, I need to do a bit of marketing as well. We have started this journey a while back and really providing insights to our clients like yourselves. 2018 publication is just freshly out. I believe some of you may have actually already received. After a very exciting 2017, my team and I actually sat down. We decided to take some parallel. We drew inspiration from the nature. Thinking about the nature, because it was too exciting in 2017, how do we calm ourselves down? And we drew parallel against the natural elements of the world, looking at what are the macro drivers, we equate that to Earth. Metals are the fundamental drivers. As in investing, there will be risk events. So fire was our element for risks. And where are the opportunities for growth is wood. And finally, as in money flow, where would the fund flow is water. So how would these 5 elements come together and harmonize with each other and reach an equilibrium? That is actually our UOB 2018 investment strategy and outlook. Take a look at our publication and you can actually see more insights from there. Sit back, enjoy the conversations by our distinguished speakers tonight. Thank you very much.
Ladies and gentlemen, Head of Wealth Management, Advisory and Strategy of UOB Overseas Bank, Mr. Abel Lim.
Patterns, valuations, sentiments. 3 key pieces of information any investor should have. Patterns are essentially cycles in the market, trends in the markets that we often see. The great monetary policies that the central banks of the world has applied, the QE, may have distorted some of these cycles. But as the world starts to normalize, some of these cycles are becoming a little bit more obvious to us. For that, we need to look towards valuations. Is an asset expensive? Is it cheap? Not everything that's cheap is good, and not everything that's expensive is bad. Purveyors of the luxury brand MS, Birkins, or Kelly's will understand this concept because of the strong global demand and also an equally strong secondary market. Sentiments. Investor sentiments is a curious thing, and humans are curious or peculiar in that sense. When enough people believe in a particular asset and its underlying value, and when there's enough people chasing a particular asset, you're going to get herd instincts and pockets of the asset being overbought and oversold. Bringing us back again to cycles. 2017 was indeed a good year for investing. In Shobby's earlier slides, you saw some spectacular returns and some of the key calls that we have made for our investors last year. Asian ex-Japan equities delivering a steady, world-beating 40%. European equities, a developed market, delivering over 10%. Our sectorial calls in the healthcare segment, 20%, and a very respectable 5% in short duration high-yield bonds. given a rising interest rate backdrop. So what does 2018 hold for us? Before I go there, I'd like to poll the room to get a feel of where you guys stand and what kind of sentiments that you possess today. Okay, the very first question clearly is a very important one, and I need you to think about this. Who do you think will win the World Cup? A, Brazil, B, France, C, England, and D, Geylang United. Please vote now. We actually have respondents for Geylang United. That's interesting at best. I think I'd like to move on to the second question, which is a lot more relevant to this forum. Yes, here we go. Which asset class do you think will do well in 2018 on the backdrop of 2017? Will it be A, emerging markets, B, developed markets, C, commodities, or D, fixed income? Please vote now. Oh, 0 for developed markets. Oh, here we go. All right, no pressure, guys. The last question, will you be investing more or less or the same in 2018? This gives us a feel of how you see the market, your sentiments. Please vote now. Remember, your relationship manager is watching, so vote wisely. Fantastic. I think it's pretty even across the room. This is very good results. And we shall land right here. MEM. If you're going to think that I'm going to break out into a rap right now, I'm sorry to disappoint. MEM really stands for monetary policies, economic growth, and market valuations. 3 key factors that we consider to help us map out how 2018 is likely to play out, lending us insight on how we're going to map the solutioning and advice that we're going to give you in 2018. Monetary policy is starting to diverge. The US started it last year with the interest rate hikes and balance sheet reduction. We saw the ECB following quite closely, slashing their $60 billion a month asset purchase program to just 30, and we are likely to see it end sometime this year. More of these central banks are likely to follow suit. But on the other side of the spectrum, we are continuing to see some central banks adopting equally liquid policies and accommodative at the same time. This is going to throw out very interesting opportunities for us, especially when you look at global investing. Economic growth. Last year was a great year. The synchronized recovery has lent itself to exuberance in many markets. Investor sentiments and business sentiments has not been higher in the longest time. This is going to lead to investors likely to invest more, spend more, consume more, and businesses considering more expenditures in their capex sense, hiring, and maybe through M&A activities. These lending a lot more value again to the economy. Market valuations. Now, we're not going to ignore the elephant in the room. Markets are expensive in certain areas. I read a very interesting quote the other day. Investing today is like shopping in an expensive mall. You need to do your research well. You need to be patient. You need to know what you want to buy, or you can find a professional shopper to help you find those things. And it's the same for investing. If you don't have the time, the opportunity to do all this, get a professional investor. They'll sort you out. But on the backdrop of this, there are certain possible outcomes and risks that we've identified. We think sentiments in investors will continue to rise, and in the business sense as well, which in itself is not a bad thing. But as the exuberance gets a little bit too far, pushing investors taking on risks that may not be suitable for them, again, running contrary to our risk-first approach to investing, we get concerned. This exuberance is also possibly leading up to inflation overshoots, a very valid point which Shorby covered earlier. That's going to force the hand of central banks around the world to tighten rate a lot faster, and that doesn't bode well for risk assets. So how do we advise, and what we're going to tell you this year? We prefer equities over bonds. Having said that, bonds is a very important asset class in anybody's portfolio. It's a great diversifier. It performs the role of a portfolio buffer, especially when we get some of those views wrong. We encourage you to consider cheaper and formerly unloved asset classes, and equities in particular, especially those whose fundamentals has improved tremendously over 2017, and we are seeing exceptional growth in those areas. Last but not least, we are seeing selective bonds that we like, and we will cover some of this later in this program. Tonight, we have invited some exceptional minds and industry experts to share some of their thoughts and their ideas and how they see some of these assets that I've covered earlier. With that, I'd like to invite you to sit back and relax as we present to you investing or riding the emerging tailwind. Thank you very much.
Next up, ladies and gentlemen, please join me to welcome Head of Emerging Markets and Asia Pacific Equities, Managing Director of UBS Asset Management, Mr. Jeffrey Wong.
Thank you. Good evening, and thanks for joining us this evening. I think we're going to start out with a poll question. The question is, will rate hikes in the US be positive for emerging markets? Yes or no? So do you have fear of the Fed, or are you going to go into emerging markets fearlessly, even though we know the Fed is going to be raising interest rates? But please enter your thoughts. Yeah, I see some people are changing their minds back and forth. Okay, I think we have a majority who think interest rate hikes will be good for emerging markets. As it turns out, I think I agree with the majority, but we'll go into that into a bit more detail. Now, the speakers so far have been pretty positive on equities in general and also emerging markets. I'm going to stick my neck out even further and say that I believe the outperformance of emerging markets is going to last another 3 or 4 years. And why do I say that? I think the answer is largely in this chart. The top line on this chart is the relative performance of emerging markets versus developed markets. The lower line is the relative GDP of emerging countries versus developed countries. So a few things to note. The outperformance and underperformance of emerging market goes in very long waves, and these waves typically last 5 to 7 years. Right, so if we look at the right-hand side of the top line, the big returns that we saw in 27, it's barely the bottom of a hockey stick. So we're just right at the beginning, right? And the driver of these returns is the bottom line, it's the economy. So I think there was a famous US president who said, it's the economy, stupid. I think we can say exactly the same thing for equities in the emerging markets. It is the direction of the economies which will be the big driver. So things like SARS, the election of Trump, at the end of the day, it ends up being those little squiggles that you see on the top line. In the end, it's the economy. So what is driving economic growth, right? And the biggest single driver of economic growth is investment. Right, consumption, yes, consumption goes up and down with the economy, but really what makes the economy go into a boom or recession is what happens with investment. And what's happened with investment in the last 5 years, it's fallen. So investment peaked in 2011 and fell for 5 years to 2016. So with this investment came the decline of emerging market economies, the downfall of the markets. Not only that, this chart I'm showing you is investment formed by CapEx, shown by CapEx of emerging market companies. The fall in CapEx from 2010 to 2015 was bigger than the fall in CapEx during the global financial crisis. And in fact, in nominal terms, the fall in CapEx was practically as great as the fall during the 97 crisis, I think, which we all remember was really serious. So it's only in 2017 that we're just beginning to see the bottoming of the CapEx. It's only the beginning of the cycle. Now, what's behind this 5 to 7 year cycle? The answer is in the behavior of companies. Now, many of you in this room might be CEOs of corporates, so I think you'll sympathize with what I'm saying. Typically, a company will not want to build a new factory until it's got 1 or 2 years of good sales. So you want to see good sales, you want to see your margins rising. So after you've decided to expand your factory, it takes another 2 or 3 years to build the factory. Then suddenly we're in year 4 and 5, everybody's factory is hitting the market at the same time. Prices coming down, you get a lot of competition, and boom, that's the end of your cycle. And you can see this in the actual data. So we take a look at the left-hand side chart, the darker line, that's a net income margin. So that's margins. Margins fell all the way from 2011 to 2015. Return on equity, the yellow line on the left-hand side, also fell. Right, so prices were falling. If we look at asset utilization, asset turns is the lighter line on the right-hand side chart. Asset turns is sales divided by assets. How many dollars of sales am I making for every dollar of factory? And that fell from 2011 to 2015. So even if your banker comes to you and says, I want to give you a 0 interest rate loan, my prices are falling, my factory is half empty, will you go out and build another factory? Right, I think the answer is no. Maybe you'll take the loan, you'll buy an apartment in New York, you'll buy an ETF on the S&P 500, but you won't be building another factory. But now we fast forward to 2017, what's happening? My margins are starting to rise. My asset turnover, my factory is starting to begin to fill up. So I can begin to think about capital expenditure, and that's what will drive the cycle. So we're really only at the beginning of the cycle. Profits and earnings are starting to rise, and as profits rise, investment will start to take place, and the cycle will continue. Okay, so if we believe the markets are going up, where should we be invested? The emerging markets have changed in nature. It is no longer a commodity-driven market. Energy and materials at the peak used to be almost 30% of the index. Today is less than 15%. What's driving the index are consumption, consumers, IT, and financials. So these are the important sectors. It's all about the play on consumption within the emerging market and future investment as well. Now let's talk about consumption a little bit, and I'd like to give a little bit of an insight into how we look at consumption. Let's take beer. Now, if I go into a country, let's say China, and I were to plot the income of every household in China, I would get a big bell-shaped curve. And because Chinese income is rising so quickly, that bell-shaped curve is shifting to the right. Now, which part of the bell-shaped curve is growing the fastest? It's the leading edge. It's the portion of the high-income households. So that we want to buy the companies, identify the companies that are selling into that high income, right, that premium sector. If you go to the left-hand side of the curve, the lower-income households, if they get 10% richer, are they going to buy another 10% more instant noodles? I think the answer is no. They will buy something better. So you want to avoid the companies selling into the left-hand side of that curve, and you want to be in the companies on the right-hand side curve. The example I show here is beer, just one narrow segment. On the left-hand side chart, high-end beer sales are rising pretty quickly in China, whereas low-end beer sales are actually decelerating, right? What do we do in our portfolios? We own the company that sells BMWs in China. We own the company that sells cosmetics into China, things that target into high-end consumption in China. We avoid instant noodles and low-end consumption. All right, are emerging markets expensive? I think the answer is no, not really. Here I use price to book, which is a measure we like to use for emerging markets, because emerging market earnings are quite cyclical. They go up and down. Very often, the best time to buy emerging markets is when E is nearly 0, right? So price to book is a more stable measure. And the dotted line is the long-term average, right? The darkest line is emerging markets. So we're right at the long-term average in terms of price to book. So we're at about fair. The lighter line is the S&P 500, right, which is obviously very expensive. So things like US equities are expensive, developed market bonds, a lot of bond yields are 2% or some 0 in the case of Europe, whereas we have fair value in emerging markets. So you could say fair is the new cheap. Among major asset classes, emerging markets is one of the few that are trading at fair value or cheap. Now back to the poll question, should EM investors fear the Fed? And in fact, I would agree with the majority in this room, and the historical evidence supports that as well. So in this chart, the darker line is the return that you get from different emerging market asset classes when interest rates are rising and the economy is expanding, right? The lighter bars are what happens when interest rates are rising, but the economy is shrinking, right? The scale here is return in US dollars per month. So if we take a look at the pair of bars on the left-hand side, that's equities, emerging market equities. So historically, over the last 20 years, emerging market equities have gone up 2% per month. in periods where interest rates are rising and the economy is expanding. On the other hand, if interest rates rise and we get a deceleration in the economy, it's not so good. Now, we also get positive returns out of emerging market credit, debt, and foreign exchange as well. So we don't, at this point in time, have to worry so much about currency risk in the emerging markets. So we don't have fear of the Fed as long as interest rates are rising together with a growing economy. So picking the opportunities within the emerging markets, I'll talk a little bit about how we do it. We believe very much in boots on the ground research. We don't think it is sufficient to go to the capital cities and talk to the corporate CEOs and CFOs. The job of the CEO and CFO is to sell you their stock. It is not necessarily to tell you everything that's good and bad about the company. We go down, my analysts and I, we go down, we sit on the floor with the farmers in India. We ask them, are you buying a tractor? What brands are you looking at? I go to Siberia. I go into the 7-Eleven in Siberia. I take a look at what's on the shelf. I take a look at the foot traffic, who's coming in and out. We go to the Atacama Desert. We take a look at the technology that the miners are using. Is it state-of-the-art technology or is it obsolete technology? And that's how we get a true 360 view of the companies that we want to invest in. Now, one simple example of where we've invested, Ping An. Ping An, you may know, is doing very well at the moment. We've been holding this stock for over 4 years. Our banking analysts went down, our insurance analysts went down, talked to actually hundreds of agents. We went all over China talking to insurance agents. They showed us the iPads that they were using, right? They're showing us the applications that Ping An was able to roll out to help straight-through processing. They can basically instantly improve your insurance policy on the spot because they have straight-through processing. They take down your details, it goes back to the computer in headquarters, and bang, you can tell the client, your policy is approved. So we saw the kind of advantage that this kind of technology was giving to the agents, and we decided that it was going to be a long-term buy. Meanwhile, in the last 4 years, the stock goes up and down with the stock market. It doesn't bother us. As long as the fundamentals of the company are on track, we held on to the stock, and now it's our clients are being well rewarded. Our team, it's an experienced team, on average 16 years of experience, very stable as well. They're from the emerging markets. We have people from Slovakia, Brazil, Poland, of course, China and India as well. And not only that, we are paid, our bonuses are paid 50% in the same funds that we're discussing tonight. So we only make money if you make money, right? And that's a very strong motivation. So, wrap up, why UBS for emerging markets? We think, first of all, the cycle has turned, so it's the correct asset class. We think we're only in the beginning of the second year of what is typically a 5 to 7 year cycle. Valuations are very fair compared to other major asset classes. The fundamentals have improved quite tremendously. With our team, you get boots on the ground research by a team that is from the emerging markets doing emerging markets. The portfolios that we form are a best ideas portfolio. We think of ourselves as the Warren Buffett of emerging markets. We look for very good companies. We hold the holdings for multiple years, as in the Ping An example. Finally, we've had very good returns. Last year, our fund returned 48%, about 10 percentage points over the index, and was top of its class in the emerging markets.
Well, ladies and gentlemen, please join me to welcome our next presenter. He is our Managing Director, Portfolio Manager, and Head of Income Strategy, Emerging Markets, and Asia Pacific Equities team of JP Morgan Asset Management. Please join me to welcome Mr. Jeffrey Roscoe.
Thanks, everybody, for coming here this evening to listen to us. As I was just introduced, my name is Jeff Roscoe. I work for JP Morgan Asset Management in Hong Kong, where I've been based for 20 years now, working for the same firm. So, and I manage Asian and the team that manages emerging market equity income strategies. So we'll kick off with a question for you again to get you going. It's a pretty simple question, although the answer is quite complex. What are you planning to do with your Asian equity exposure in 2018? You're all based in Asia, so you know Asian equities well. What are you intending to do with it this year? Can we start? Oh, that's good news. Fantastic. Well, that's a very overwhelming response from you. Of course, there is no right answer. The right answer depends on your personal circumstances and what you have in your portfolio already. And the theme of my presentation is about balance. It's about achieving balance in your life and in your investments. And in many parts of our lives, we're expected to achieve balance. Work-life balance is a phrase that's used a lot. I'm here tonight working, not with my family, to help you maximize the use of your investments. But tomorrow morning, I'm back on the plane at 7:30 in the morning, and I will get to my daughter's assembly by lunchtime tomorrow and see her perform in her school assembly. So that's my work-life balance. And when we run portfolios, we have these same conflicting needs. We need to try to maximize the return we achieve, but as Shorby said earlier, we need to manage risk. We need to manage the risk in our portfolios, and that's what we think a lot about when we're balancing our portfolios. So where does a mixed asset Asian equity and fixed income fund fit in the risk-reward spectrum? It's not at the highest risk. Emerging market and Asian equities are very volatile. They're the highest amongst the highest risk assets. Fixed income is obviously significantly lower risk. If we combine the two, we sit in the middle of the risk-return spectrum. And income equities tend to be a little bit less volatile as well. The good news is we can change the position on this curve in the portfolio. We can buy more equities when they're relatively good value, and we can buy more fixed income when we're concerned about markets, and we can manage risk-reward for our clients, and that's what we aim to do. So why would you own income stocks in growth markets like emerging markets in Asia? Well, the first thing is there's a lot of them. There's actually a surprisingly high number of high-yielding stocks in Asian markets, more so actually than in many of the developed markets. The second reason is over very long time periods, they've outperformed. That surprises people. They think of Asia as being a growth region, but actually high-yielding stocks perform relatively well through the cycle, and it's something you want to be exposed to, as well as the fact that you want income generally on your portfolios. So how are Asian markets valued now? Jeffrey showed you earlier the price-to-book measure, which actually is the best measure for looking at Asia and emerging markets. And again, Asia is right in line with its long-term average, as you heard on emerging markets. People like to talk about PEs a lot, and what we've shown here is the discount of Asian equities to US equities. We're still at a 25% discount on PE to US equities. And actually, that's pretty close to the maximum discount that Asian equities have traded on. So despite the good performance of the last 2 years, the discount of Asian equities, as Jeffrey said, many other assets are quite expensive. Asian equities are still close to their average valuations, and average is reasonable. What do average mean? It means we should expect average returns. And average returns in the past have been 9 or 10% from owning Asian equities. We think that's a sensible expectation at this point in the cycle. So not the spectacular returns of the last 2 years, but still acceptable and still pretty good compared to other asset classes. Why would we still be optimistic? Earnings are getting better in the Asian region. Again, Jeffrey showed you earlier that earnings had been very weak in emerging markets, literally from 2011 to 2016. In the last 2 years, we've seen positive earnings revisions, and that's good for equities. Equities are reliant on profits. They must make profits, and then we can value those profits. So this is a good reason to be still optimistic on Asian equities. So if you take my premise that you can still make money in Asian equities, how would we construct a portfolio with the right balance of risk and reward? I'm married with 2 kids, so I don't have the same risk appetite as this guy. He probably is a little bit out there in terms of his risk appetite. So we're trying to put together something, and certainly within equity income, we'd aim to be slightly less risky than this. Basically, high dividend stocks have 2 main characteristics, one of which is they're slightly more defensive than the broader market. You know, stocks like REITs and telecom stocks that have less volatile earnings. But at the same time, there's a lot of high-yield stocks that are more cyclical and more geared to the economy. Banks would be a good example. Oil and gas companies, for example. Some parts of the tech industry actually do have good dividends. So we can balance out defensive equities with more aggressive equities. And as we showed on this chart, actually, we want to be more aggressive at this point in time. Economies are improving and they're growing. Earnings are being upgraded. We don't want to be ultra defensive at this point in time. So the right balance of risk reward for us at the moment is to take a little bit more risk. So we're overweight equities in our income strategies, and we're owning more value-based equities, which we think can perform well in the coming years. Financials. Financials are 40% of our equity income portfolios at this point in time. Why? Because they're still very good value. They've actually performed much better in the last 3 or 4 months. But across the region, financial stocks trade on about 9 times earnings. If we strip China out of this, they still trade on 11 to 12 times earnings. So yes, financials in China look very cheap, but even elsewhere, they're pretty good value. So we own banks in Singapore, Hong Kong, Thailand, some in Australia, and we're seeing pretty good value across this sector. Coming back to the theme of balance, the world economy actually looks more balanced than it has done for quite a long time. For 5 years, we had rolling crises. We had dramatic slowdowns in China. We had multiple crises in European countries. We had the collapse of oil prices, iron ore prices, coal prices. But in the last year or two, we've seen a little bit more stability, and that's a good thing for corporates in general. And I would expect to see a pickup in risk appetite. We're already seeing it in the leading indicators, sentiment indicators, as was discussed earlier. So this is the outlook of our fixed income team. About 35% of our multi-asset Asian income funds is in fixed income at this point in time. And the fixed income team globally think there's a 70% chance of above trend growth. That's good for credit because it means there isn't much bad debt around. It's not very good for duration because we think yields will rise slightly. So the conclusion is to be underweight duration and long credit. And probably the most important conclusion from this is to be overweight equities. It's the view of the fixed income team, but it leads us to be more positive on equities because equities benefit from more growth. Fixed income doesn't benefit that much from more growth. So we're aligned. Credit spreads have come down. There's no particular reason for them to go up a lot, but you should think about fixed income producing much more moderate returns in the coming years than it has done in the last 10 or 20 years. And I mean much more moderate returns. Asian credit earning in the region of 3 to 4% type total returns in the next couple of years, if you think yields are going to increase slightly from where they are now. So much more moderate returns in fixed income, still a place in your portfolio, better returns at this point in time from equities, and consider to continue to look at the risk reward of the two asset classes. Overall, the portfolio, we can put together a portfolio in Asia yielding about 4.4%, combining equity and fixed income. And the volatility in the last 5 years has been about 7%, and returns have been slightly higher than that, in the region of 8 to 9% over the last 5 years or so. So we think that's quite a good combination. We care a lot about the combination of risk and reward, not just about either achieving very high returns with a lot of risk, or achieving no return because we're too risk averse. It's the combination of the two that matter to us. So where are we now? Actually, as we speak today, Asian equities are up 80% in the last 2 years, and they're only back at average valuations. So we still think you can make money in Asian equities, and we think you can make better money, better returns in Asian equities than in bonds, because we think bonds will produce relatively low returns going forward. Within equity markets, we see opportunities in value stocks. Our equities trade on about 10 times earnings, 10.5 times earnings, which is significantly cheaper than the broader market. And then within the bond market, we're underweight duration because we think yields will rise slightly from here. So those are our views overall. I just wanted to say at the end that balance is not about being boring. You can take on some risk. We'd like to help you achieve your objectives and get to your targeted aims, but with the right level of risk. So thanks very much for listening to me.
Up next, ladies and gentlemen, is the global strategist of East Spring Investments Singapore Limited. Please join me to welcome Mr. Robert Roundtree.
Well, thank you very much, ladies and gentlemen. Now, you've heard an awful lot about emerging markets and Asia this evening. But does this mean that we can forget about some of the developed markets? And in particular, I want to talk about Japan. Now, Japan has had pretty bad 2015. It sort of turned around in 2016. It rallied in 2017. So we're going to kick off by asking you a question. Do you think Japan has had its run, or has it still got room to deliver more? So, your clickers. Oh, I like the way this is going. Oh, no, I don't like it. Yes, I do. No. Yes. Oops. Clearly divided. Clearly divided. And I can, oh, no, I like that. Yeah, well, let's finish it now. I think let's cut it while it's in my favor. No, cut it while it's in my favor. Yeah, forget that last piece. I can understand why. Because we've seen in Japan a stop-start kind of market. Now, you look at how it compares with some of the other developed markets. There's the US. There is Eurozone. But look at Japan. Look at it. In yen terms, it's actually outperformed the US. Now, that will come as a surprise to a lot of you. But why is this so? What's actually happening there? If you look at Japan, you'll notice that it's a series of start, stop, rallies. If you look at the US, it's more or less been, with a little exception, it's been more or less straight up. What's causing that? Well, a lot of it is because people are focusing on Abenomics. You know, Mr. Abe gets elected, he's going to reform, wow, the market takes off. Oh, we've done too much. Yes, he's going to reform the market. No, he's not. The market falls. Yes, he is. He gets re-elected. Yes, he is. I can tell you the next step in this cycle for Japan. And it's going to be this spring when the Shunto comes in. The Shunto wage agreement, if it comes in at 3%, which is what Mr. Abe is trying to achieve, suddenly you're going to see a, wow, Abenomics is working. And you'll see a rally. But if it comes in at 1.5% or anything less than 2%, people are going to say, oh, Abenomics is not working. And you'll either see a sell-off or a consolidation. Should we be looking at that? Well, I don't think so. Look, have a look at this. This is Japan. Have a look at this. Discipline, precision, teamwork, stereotyping. And I bet none of you were thinking about Abenomics. So what should we be focusing on? Well, have a look at this. Let's look at unit labor costs. Unit labor costs in the States have been falling, and people have been rewarding that with ever higher valuations. Wow, so what about Japan? And we've been ignoring this? What about company borrowing? Japanese companies have been restructuring, they've been paying down debt. The net debt to equity ratio is now around 30%. That's leaving more money for you, the investors. It's less money that's going to the banks. That's good. What else should we focus on? This. The bank's lending is increasing. Banks are funding growth. But while they're funding growth, look at this. Look at what's happening. Companies are making so much cash that the deposits are growing faster than the banks can lend them out. And are we pricing this in? You've just heard that Asian banks are cheap. Japanese banks are uber cheap. We're not recognizing it. And there's a lot of stuff that we're not recognizing that is leading to a massive increase in margins. Japan is not an Abenomics story. It's in the middle of a massive restructuring, which is only slowly starting to be partially recognized. And the trigger each time is Abenomics, but the reality is this restructuring that's going on. So, what about profits? Well, as a result of the sales in the US, restructuring in the US, we've seen some pretty good profits increase. And there's Europe, and there's Asia, certainly supports the Asian story. There's emerging markets. But look at Japan. The profits growth is virtually the same as in the US. But we're putting high valuations on the US, but we're not doing the same in Japan. Why? People are not seeing what's happening right before their eyes. They're focusing on the macro, not the micro. Well, that's okay. Maybe Japan's expensive. So let's look at a composite measure of value, which includes the price to book and the PE. We've got the value ranges up there. And when we look at the US, it's very expensive. When we look at Eurozone, it's up there. But look at Japan. So that pricing has not, that growth has not been priced in. Is it likely to continue? Yes, it is. Let alone the boost from the currency. Whereas the US dollar has come off a bit, it's still looking generally across the board fairly expensive. Not as low as it could be. The euro is certainly better, but look at Japan. The yen is still bouncing along a 40-year low. Now, that will be good for manufacturing profits. And there's a very close correlation between this and a boost to profits from the yen. But I want you to hang on to that thought because I'm going to come back to it in a minute. And when we look at the yen per se, and you're all saying, well, where's the yen going to go? Well, as you can see, over the long term, the Bank of Japan has tried to keep it within a broad range. Again, I'll come back to that in a minute. Liquidity. There's still plenty of liquidity there. You've heard about central banks tightening. Well, it doesn't look to be the case in Japan. Because if we look at the central banks' injections into the economy as a percentage of GDP, that's what we have for the US. That's what's projected for this year on Fed guidance. That's what we've got from the UK. That's what we've got from Eurozone. And look at this. That's what we've got for Japan. Significantly more liquidity. But you'll notice towards the end of last year, that upward trend started to flatten out. And that has caused people to fret that maybe there is still tightening going on by the Bank of Japan. Now, that fear was exacerbated just last week or a week or two ago when the purchases of JGBs, of government bonds by the Bank of Japan fell. And everybody was worried. But you only had to look at the chart of the net purchases and you can see that it's happened before. The policy within Japan is to control the price of money, not the volume of money. So if we see a sell-off on similar fears, that seems to be an opportunity. The Bank of Japan still has its foot hard on the monetary accelerator. So, I titled this, "There's some exciting things happening in Japan," and that's reflected in this last chart. Remember we said that the yen did have a big impact on manufacturing profits and exporting profits. That's true. But if I plotted the yen against overall profits in Japan, there's virtually no correlation. When I look at the impact of the yen on total corporate profits in Japan, the impact is minimal. So if it was minimal, you would expect that movements in the yen would not affect the stock market. But look at this. Here we are. We've got periods. The yen weakens, strengthens, weakens, strengthens again. And it shouldn't affect the stock market for the reasons I've just outlined. But if you look at what has actually happened, every time the yen weakens, people suddenly say, "Oh, buy the market." And every time it strengthens, sell the market. Buy the market, sell the market. And it looks as though this year that the market is starting to realize that this is not correct. I don't know what will change the sentiment for this, but it looks as though it's starting to happen. If people are starting to price Japan on the reality and not on the perception, we've still got a long way to go. So we can get that growth through the developed markets, through Japan, that we're seeing in the emerging markets as well. So the Japanese story is really a very, very simple one. It's a restructuring story. The corporate restructuring is resulting in very strong profits and extremely high cash growth. Companies in Japan are very, very strong indeed. This progress hasn't been rewarded. The yen is ferociously competitive. Liquidity is not an issue. Equities are fair value. But until the penny really does drop, then we could see a continuation of those stop-start rallies. Ladies and gentlemen, put some Japan into your portfolio. Thank you very much.
And thank you very much, Mr. Robert Roundtree. Up next, ladies and gentlemen, our senior economist of global economics as well as market research from United Overseas Bank. Please join me to welcome Mr. Swante Kien.
Good evening, everyone. Now, just now, Shelby earlier talked about the 5 elements, right? You know what came to my mind? 5 elements. Immediately, UOB, look at the logo, 5 elements, right? Jump to my mind. Okay. Okay, so joke aside, I don't know whether it's true or not, just observation. Okay, the other one, more pertinent to us. Here, in our personal lives, Shelby touched on just now, investment, right? Investment, and the other thing, there's one thing, I don't know whether you noticed, she talked about life expectancy. All right, life expectancy. My colleague in the team wrote a report on not just life expectancy, but our aging society in Singapore. Do you know what's a life expectancy for Singaporeans in 2013? If you're born today, 2018, if you're born today, it's 83 years old. 83. In 1965, what's the life expectancy at the time for Singaporeans? 65. Okay, so that means our life expectancy is great. Because of this so-called better healthcare, exercise and everything, it's going to have an impact when it comes to your investment. So I don't have a solution for that, but Shelby has a solution. So later go and look for Shelby. Okay? So we need to have enough income when we retire. You know, we're going to live long. Okay, I'm going to go with the tradition. Going to have a poll. Okay, come, let's have a poll. All right. So it's about currency because we have a lot of all these questions on or solutions for equities. So tonight, let's look at currency. What is your expectation for the Sing dollar at the end of this year? Is it going to be stronger compared to today, about the same level, or weaker than the current level? The current level, if you look at the screen, is 1.3050. Okay, come, let's vote. What do you think it should be? Weaker, stronger, similar, not so much. Wow, exciting. Okay, now, just a month ago, in December, Sing dollar was 1.35. Okay, so come, let's go. Wow, very close, not too sure. Stronger. Okay, so, wow, still going. Come. All right, wow, almost evenly split. Okay. So majority, no, I wouldn't say majority, thin majority is looking for a stronger Sing dollar. Remember, today is 1.30. That means you're looking at 1.28, 27, 26, that kind of number. By end of the year, no, not tomorrow, end of the year. Okay, so we'll move on from here. We know that we'll see what happens later, okay? Let me see if I can convince you a bit of which direction. Okay, hi, my name is Tekin. I'm from UOB, so Shelby is my boss. Shelby is my boss, and Abel is my boss too. Okay, so I run this economics and research markets team in UOB. And what I have here is tonight, we'll share with you some of these, our views on what earlier speakers talk about tonight. Okay, earlier speakers talk about investing in equities, right? All these, Abel talk about the MEM, monetary policy, economics, and valuation, etc. So let's take a look. What we have here? We have here in quite a friendly environment, actually, right now. Earlier speaker already talked about for investment, okay, for this year. We called it so-called Goldilocks, but this Goldilocks, that means it's just nice, right? Not too hot, not too cold, Goldilocks. But I put a bracket there because my colleagues are very good with all these words. Goldilocks may be turning into OD-locks, right? Getting old, getting gray, aging society. How Goldilocks may be OD-locks. So there is also, Abel mentioned earlier about this risk, right? Some of these risks that we should think about, we should keep in mind. Shelby also talked about that. So let's take a look. Okay, central bank. Abel mentioned monetary policy. Let's look at this line, the blue line, all the way up. That is central bank asset purchase, liquidity injection, buying assets, putting liquidity into the system. There's a lot of it. How much? 19 trillion. The major central banks, 4 major central banks, 19 trillion. If I draw a red line at the bottom to show the trend. If you follow the trend, if this number follows the trend, it should be way less than 19 trillion. That means there's a lot of liquidity in the system, which is going to be positive for asset prices in general. Okay, asset prices in general. Now, what's 19 trillion? I cannot imagine, right? If you have millions already, I'm very happy. What's 19 trillion? Whatever. Okay, that's the scale of it. The trillion is on your right-hand side, on the extreme right, the tallest. There's even taller than the space station. Okay, don't know how many, 600 miles, 1,000 kilometers. If you stack $100 bills, one by one, 1,000 kilometers up. And then you have 19 of those. 19 trillion. That's how much money we are talking about. Just unimaginable amount of money that is still in the system. Okay, that's still in the system. That should be positive for investment and also for the economy itself. Okay, I'll show you how. Okay, the Fed we'll be talking about all these balance sheet reduction. Okay, by end of 2021, it will reduce by 2 trillion. But we have 19 trillion in the system. Okay, so despite this reduction, it is not going to be so tight that you could cause a problem. If you look at this, 2 trillion, 19 trillion, we reduce by 2 trillion, there's still quite a bit of liquidity in the system that will be generally positive for the investment environment and for the economy. Okay, you look at these spaghetti lines. Don't worry, don't look at it. I'll tell you what it is. All these spaghetti lines, very hard to see at the far. Now, the top line, this is a PMI, Purchasing Managers Index, where we use to, let's say, manufacturers, what kind of expectation for the manufacturing activities. Is it good or is it bad? Anything above 50 is good. So the lines now, all the way up, are generally positive for the economy. So after all these years of injection, central bank injection, the 19 trillion, it's like giving enough steroids to the patient. You give me enough steroids, I can win gold medals also. Okay? So this is the same thing for the economy. All this injection into the system. Look at top line. The PMI, very strong. That is Germany. Can you imagine this? Look at this, Germany, PMI, all the way to the top. Okay, manufacturing activity at the top. And then the euro area is a red line. Right? Or somewhere down from the top line is euro area. That's the reason why, if you look at the world today, why is it so positive? One of the reasons is the US expansion, supported by China expansion as well, and now European activities also have been picking up over the past 1 year or so. And that's the reason why, one of the factors why the euro has been performing so well. Right? The European activities, European economy has been performing very well. And somewhere in the below the red line, you see a zigzag, up, down, up, down, up, down. Okay, up, down line, that is the UK. Okay, the UK, after the Brexit vote, where the dip is, you can see that there's a dip, right? That's Brexit. After Brexit, a bit of struggling, right? A bit of struggling for the manufacturers. Confidence issue, should I stay? Should I move my factories out of UK to Europe? And that's what is showing here to you. So overall, all the activities are for other countries. At the bottom is actually still expanding, but not as fast. Still expanding. So for the whole world, for the whole world global economy, the outlook for this year remains quite positive. Not all just good news, right? I want to tell you, is there any bad news or not? One of the earlier speakers talked about recession risk, 5% recession risk. Here it is. This is a chart produced by the numbers from the US Fed. The red line there tells you probability of recession. Okay, probability of recession maybe in the next 12 months. How does it look? It's not zero. It's never zero. It's just above zero, never zero. It's now about just picked up a bit, but compared to those recession periods in blue, we are way below those recession periods. Okay, we are way below. So it's not zero, picked up slightly because of, I think, some overheating here and there, and some concerns, the yield curve, etc. But overall, the bigger picture is recessionary risk remains relatively low at this point. So if you see the one to the left is where global financial crisis, 2008, a big spike, continuous spike in the red line, then you start to worry. Are we seeing that right now? Not yet, right? So for the next 3 months, 6 months, 12 months, I think one of the smartest things to do is to stay invested. How to invest, where to invest, what to invest, look for Shelby again, okay? Okay, all right. So okay, how do we see this from our market strategies team? How do we see in the next 12 months? Interest rate, for sure, will be going up. Okay, we expect the Fed to hike 3 times interest rate. Okay, to hike 3 times interest rate. So the US LIBOR rate will continue to move up. And then the SIBOR rate, the SOR rate, will continue to move up. The 3-month LIBOR, after 75 basis points, by end of this year, should reach about 2.4% or so. For the 3-month SIBOR, roughly around 1.8%. Today is about 1.2 or so 1.8%. So we should expect interest rate to gradually move higher. So be prepared for that. Okay, why is the dollar so weak? Just now I saw, we have the chart. You expect the Sing dollar to get stronger because the dollar has been very weak. According to our strategists in the team, One of the reasons why is because the yield curve flattening. Okay, the short-term interest rate, the 2-year rate in the US Treasury has been moving up in accordance with the Fed expectation, but the long-term interest rate, the 10-year rate, is not catching up fast enough. So there's a flattening of the yield curve, and that kind of environment is not positive for the US dollar. So one of the contributing factors is the flattening of the yield curve. So is it going to persist until the end of the year? It's very hard to say at this point, right? But the way that we look at this is, at the end of the year, probably we'll see some catching up in the long-term yield after the Fed has done the 3 times rate hikes this year. Okay, so for the Sing dollar, the chart out of date already, this one, right? It's showing 132.85. Today is 130.50. It's out of date already. But okay, the question is are we going to see the Sing dollar to continue to strengthen? Now we have to be careful with this. Although just last year, 1 month ago, 135, now it's 130, we have to be careful of extrapolating this kind of trend, right? We have to be careful extrapolating this kind of trend. The dollar has been down since early last year, 12% in general, the index, 12%. Okay, the dollar, is it going to continue to go down? If you continue to go down, that will have impact on what? That will have impact surfacing in the inflation front, right? If the inflation pressure builds up, then the Fed may have to more actions might have to be taken by the US Fed in the interest rate part as well, right? So that is going to impact on have a positive effect on the dollar. So these are some of these factors that we have to think about when we look at dollar. The way they look at it is, first half of this year, the US dollar may stay a bit under pressure. Second half, the US tax cut, balance sheet reduction, right? The US balance sheet reduction, and all these other factors, inflationary pressure may be positive for the US dollar in the second half. So we expect the dollar to come back a bit in the second half of the year. Exactly how much, I cannot tell you now, because we are coming out with a report tomorrow, or Monday. So once we come out with a report, our colleagues here will be able to send you a copy to give you the latest view on how we look at this currency. From 130 to, if the US dollar strengthen, back to what level at the end of this year, okay? So basically, that's what it is. I'm running out of time. Fed 3 times of hike, and then the 3-month LIBOR interest rate. I took out the currency values, so I only put in Asian currencies, not just Sing dollar, in general, should bias a bit stronger in the first half, but may give up a bit in the second half. Okay, so that's all I have for you. Thank you very much. Thank you.
So we have heard from all our distinguished speakers, and you will have another opportunity to ask them questions again during the panel discussion. But just a very quick wrap-up. Shorby did promise you that we're going to share some of our key ideas for 2018. And these are some of them. On the equities front, although we did not speak about Europe continues to be one of our key asset calls that we like in 2018. The structural reforms, the earnings growth, all, and in fact from the earlier PMI data that Tekin shared with us, all looks exciting. But we are looking at certain risks that might surface throughout this year, namely political. Number one, there's the Italian election. There's a Catalonian push for independence. And also we are not entirely sure how Brexit is going to impact European growth in general. We heard from Robert, exciting news in Japan, unloved, undervalued, or rather very fair value, with exceedingly attractive fundamentals, which every investor should consider as part of their total portfolio. Emerging markets, I think we heard a very compelling story by the 2 Jeffries, to be exact. The growth or the structural reforms that the emerging markets have gone through is finally taking off. In fact, if I'm not wrong, 2017 was the first year that emerging markets outperformed the developed markets after 5 years of underperformance. So we believe that there's still a lot of legs in that area. On the sectorial play, we know that demography in the world is not changing. The aging population continues to be a bother. Healthcare is one sector which is to us is an evergreen. It's going to be a very strong story for us to tell going forward. Last but not least, financials. We like the fact that interest rate is rising. We also like the fact that the economy in general is improving, which is exceedingly supportive for financials. And at the same time, we might even have a policy boost in the form of the new Fed chairman in financial space. Fixed income. I think we can pretty much speak about Asia and emerging in pretty much the same breath. But in particular, local currency. We think that local currency would give you the additional booster in the asset class. We all know also that interest rate is going to rise in 2018 or continue to rise in 2018. As such, we recommend short duration high yield bonds. Why? Because of its low sensitivity to rising interest rates. And we saw how it performed last year, 5%. Tekin covered some interesting ideas in the foreign currency space. I think the commodities currencies at this current juncture looks the best, especially in the Aussie front, with a less hawkish RBA, and all this lends tremendous support on the Australian currencies. Last but not least, we continue to believe that Europe is underpriced today and is likely to continue to strengthen into 2018. So for those who are going to spend some time in Europe sometime this year, I think you might want to consider hedging your position today. Before I vacate the stage, I'm going to poll you again and ask you two of the same question I asked earlier on to see if any of your thoughts has changed at all. So let's have the very first question back again. Which asset class do you think is going to do well in 2018? Please vote again. Oh yeah, this, I forgot to tell you, we're not going to show you the answers this time around. We're going to use it during the panel discussion and to see if anything has changed. But please do vote. Okay, I think that's enough time for voting. The next question, again, will you be investing more or less or the same in 2018? Please vote now. Thank you. Thank you very much for your kind attention. I'm going to vacate the stage now as the event organizers set up the stage for the panel discussion, and we'll be back very shortly. Thank you very much.
This is the moment where we will be proceeding for our panel discussions as well as our Q&A, and we would like to welcome back all of our speakers, and alongside with that also who will be moderating our panel discussions, Ms. Chloe Cho, our presenter and executive producer of Channel News Asia Media Corp. Let's give them all a big round of applause.
Hello, everyone. Good evening. I hope you're having a wonderful time. Great company, great conversation, and some brilliant minds who really set us up for an insightful conversation. So I'm sure that many of you were here about a year ago, and all of us were just bantering at the table. Do you recall exactly a year ago around this time, what was the consensus view? That it was going to be a strong dollar that would characterize 2017. With the benefit of hindsight, what happened in 2017? The dollar sank to a 3-year low. That's where we are. Could the same happen in 2018? Why is it the case? We've got some of the smartest people in this part of the world, and everything that they say makes sense and is backed by data. But it's just the confluence factors that can really influence markets, and then you've got market forces doing different things. So what are some of the things that could derail the base case scenario? First of all, Abel, why don't you reveal the poll answers for us?
So we'd like to see the results of the second poll right now. So could we have that on the screen right now? So the very first question that we had for you was which asset class will continue to do well in 2018? Most of you believed that 75%, or at least 75% of you believe before we conducted the talk, Now we have 86% of you. So, gentlemen, well done. Wow. So, clearly, you have done a good job in presenting the case for emerging markets and Asia. Let's have a look at the second. It also looks, unfortunately, for Mr. Roundtree, that the developed market CAM has actually fallen a little bit. So we might have to explore your Japan thesis a little bit further as the panel discussion goes on. For the next question, will you be investing more or less in 2018? I think overall we've done a pretty decent job. Yes, most of our investors will be investing more in 2018, but taking our advice, hopefully, because we have identified quite a number of interesting investment ideas for you, detailed in my last chart just now. So with that, perhaps I'd like to hand it back to Chloe.
All right, so many of you want to put more money on the table. You want to go all in, deep dive into the emerging markets. But let's think about what may derail your base case scenario. We have, for the first time in about a decade, 3/4 of the world's economy in GDP terms actually growing in an upswing. That's a good thing. But what could derail us? You've got Fed's rate hikes, but we even have a former central banker here, right? When you're not pushing for Japanese equities, once upon a time, you used to be a central banker for New Zealand. So let's try to break the myth or try to decipher how markets work. After all, we have some of the smartest people again. So first of all, the yield curve control. It's true that central banks can control the yield, at least at the short end, but at the longer end, that's sort of up to the market forces. Is it possible that with this rosy outlook, a deficit-funded Trump tax cut, that all of a sudden it actually stokes inflation and the yields actually back up far more than what the new Fed under Jerome Powell had intended? And ultimately, the consequences for EM, Asia, it would be there. It would be there. It would not be, dismissive.
Yes. Well, I mean, if the question is at me, since you're pointing pointedly at me.
Yes.
We were probably one of the few this time last year, resurrecting the US twin deficits, the budget deficit and the current account deficit, as a percentage of GDP, because that tends to be a very good indicator of where the dollar is going to go. Now, in terms of timing, it's absolutely lousy, but in terms of direction, it's very, very strong. So assuming that Mr. Trump comes through with a huge budget deficit, it was pointing on the basis of the consensus forecast, pointing it one way down, and that was dollar weakness, basically, intermittently punctuated by strengths as interest rates move. But generally, the trend would still be towards the downside because of that twin deficits.
So does this mean that you were saying the dollar, it's a tough call, but in the end, it's going to stay relatively depressed? Does this mean that the US dollar actually decouples from the interest rate cycle? There have been about two cases in recent years. You had 1994 to 1995, mid-90s, and then you also had the mid-2000s, about 2004 to 2006, when the Fed might have been hiking, but because of concerns about fiscal accounts, and in this case, you even have trade protectionism, ultimately the sentiment is really not for the dollar. Do you think that will be the case again?
Okay, for the interest rate hike cycles, in the past, there were occasions in the interest rate hike cycles, the dollar actually weakened. Okay, so we are probably seeing that similar kind of reaction again this time. For the dollar, for instance, last year, the US dollar was down 12% or so against the major currencies. So probably we are seeing that kind of a reaction despite the Fed hiking interest rates. So this time around, maybe another 3 more times, the Fed, and that could be putting some pressure on the dollar again. But we have to be careful again about extrapolating. It's already down 12% last year, so it's going to go down another, 10%, 6%? So that we have to be careful with that because, as you mentioned just now about the yield curve control, the Fed may not be able to control the longer end. Which means if the inflation expectation, after the dollar was down 12%, there might be inflation impact showing up. Higher crude oil prices, there might be inflation impact on the US. So if that inflation expectation builds up, your long-term yield might pick up again, and then where we saw earlier, weaker dollar was because of the flattening and the steepening of the yield curve, then dollar may come back again. But is it going to come back a big way? So far, no. It may just come back slightly. For instance, against the Sing dollar, maybe slightly stronger against the Sing dollar, slightly higher dollar Sing, but not going to be in the 140 or 145 kind of range.
Right, so steepening yield curve, that's good for financials, Jeff, right? And you've been advocating financials. Over the past 2 years, you've had average returns of 20+%. Good for you, well done. So at the end of the day, whichever happens, banks and financials, the way to go here in Asia?
Generally, yes. Financials are beneficiaries of rising interest rates. Actually, I think it's slightly... In Asia, most banks are much more geared to short rates, not long rates. So people think banks are a play on the yield curve because if they borrow very short and lend over 10 years, then they're a play on the yield curve. Banks in Hong Kong, Singapore are very geared to short interest rates, which anything from 0 to 2 years. And what's happened there? They've moved up very sharply. So rising rates is good for financials unless it causes some kind of credit quality issue, which we wouldn't expect to see in improving economies.
So the number one question, I think, on a lot of people's minds is, are we seeing a peak to the bullish sentiment in equities? Yet, Jeffrey, you're saying people should just go dive way in with their diving suits into emerging market equities. In fact, you are saying that we're only about not even halfway through the bull cycle, and there is far more room to go. I mean, if long-term yields spike up in any way and the dollar spikes up, let's say, for whatever reasons, will that at least give you some room to hedge or at least find some protection so that people are not completely swimming out in naked?
No, I would, if that happens, if you get the spike in interest rates, the dollar rising somewhat, I think it will be one of those squiggles that you saw in my long-term chart. Right, because in the end, it is the path of the economic cycle that's going to drive the big 5 to 7 year trend. Now, there's still a little bit of this knee-jerk reaction in the emerging market equities. When the dollar goes up, people think, oh, it's bad for emerging markets and so on. I think, like the Japan chart that Robert showed, this is a bit of a memory thing, right? Back in the 1980s, we had the tequila crisis. 97, 98, we had the Asian-Russian crisis. What was going on? People were borrowing in US dollars hugely, right? So when the problems came, you had to pay back the debt in US dollars. Your own currency was going down, and there's a problem. But since 97, 98, emerging markets have been paying down their US dollar debt. And today, actually, emerging markets are net lenders in US dollars, mainly through their holding in treasuries in several major countries. So the correlation still is there, but the fundamentals don't support it anymore. So it doesn't bother me if the dollar has a bounce. Interest rates rising, steepening yield curve, if that's normally associated with an accelerating economy, don't have a problem with that either. I'm more scared of an inverted yield curve, which would indicate the economy is decelerating. Yeah.
Abel, do you want to weigh in?
Yeah, so far we've been discussing pretty much the shorter-term impacts that can derail an emerging market recovery. But I think something that was not discussed so far is actually the introduction of the middle income of the emerging markets coming into the system. I believe there's over 160 million new middle income that's coming into the world over the next 5 years. And the vast majority is going to come from the emerging markets and Asia. That is going to introduce a lot of value in terms of how they consume, how they entertain themselves, how they invest. And over the long term, and you mentioned this just now, the emerging market run is going to be at least a 3 to 5 years run. So I think there's still a lot of value in that space, which is not discussed pretty much so far.
So also a lot of questions coming in. Most of EM equities had solid performance. What will be the positioning or allocation for EM equity portfolio in 2018? So Jeffrey, you had 48% returns?
That's right.
Yeah, 48% returns last year. And I'm surprised you're not sitting on a beach in the Bahamas or something. Well done for working. You obviously can't repeat the same thing. You've got to do something different. So this year, as you advocate investors to go all in on emerging markets, how should they perceive things differently?
Right.
How should they invest?
Well, I think in the end, I think diversification is still necessary, right? I wouldn't go all in into one sector or the other. I would agree with Jeff's comment on financials, for example. So last year we saw a great run in internet stocks and other growth stocks as well. Financials did very decently well, but we think it's just the beginning for financials. They're starting from a very cheap base, so we do share that view. And within that, I think consumption also, basically any sector that is economically sensitive at this point in time will do well. So financials, but also consumer discretionary, playing this premiumization that I mentioned, the increase of the middle and in fact upper middle class consumers as well. So consumption, consumer cyclicals, including cosmetics, high-end cars, all those sorts of things, luxury goods as well. So they will tend to do well at this part of the cycle. Where we would be underweight would be highly defensive sectors, so utilities, telecoms, other bond proxies, especially when bond yields are most likely heading up.
And how would you deal with China, Jeff? Because Chinese equities actually in China, in the mainland, and in Hong Kong outperformed the S&P 500. It almost felt like the Bitcoin, but unfortunately, Bitcoin did far better. So at this juncture, would you advise investors to stay away from tech, especially the usual suspects, because they're at heroic valuations? I know you told us not to look at valuations, but still.
I
you said
say
price
don't
to
look
book,
at valuations.
not PE.
No, I look at PE, but price to book is the better measure for valuing the whole market. I'm the wrong person to ask about tech stocks because they don't have yields. So I run equity income strategies. Everything we own has a yield of 3% or more in general. Clearly, they're very good businesses that did very well last year. Why did they perform? They performed because their earnings forecasts went up a lot. What will happen next?
Would you stay away from Chinese tech at heroic valuations?
I think tech will have winners and losers, right? And big ones. So our overall tech weight is a mild overweight, but that includes hardware, semiconductors, and we can talk about that. That's a very attractive sector for us still. In internet, we are sort of fairly neutral. We picked what we think are going to be the winners. We think there will be more losers than winners, but once you've got the winner, and we're in this big get bigger phase still, then you can make money still. We still find value in selected internet stocks.
Right, and Robert, if everybody here follows your advice and they get into Japanese stocks, and you said that it's not a downright straight play between the dollar yen and they need to look at the fundamentals. Do you think it's possible that there might even be a catch-up between the performance of the Nikkei with the JASDAQ? Because the JASDAQ has been the index that's been on fire. The Nikkei, even with the recent bumps that it had, it's still, even at 24,000, 40% below its all-time highs, bubble highs of 1989.
Yes. I mean, the tech stocks just ran globally, as we know, and that's left a lot of, or took a lot of the attention away from some of these other sectors. The financials have been mentioned in Asia. The financials in Japan are in an extremely strong position. They've got to be considered. So the answer is yes, but there's this perception still that between the yen and the strength of the yen and the market. And that's a devilishly hard one to break. So it looks as though one hopes that it's breaking now. If it does, then you'll see a very strong market. If it doesn't, then that strong market will be tomorrow. So this is why we say to people, when you go into Japan, it's not a straightforward story because you're dealing with a perception that needs to change. So the correct way is to go in, buy it, tuck it away, and accumulate. And that way you won't be disappointed.
Is it also possible that investors also have a question mark over investing in Japan Inc.? What about the series of scandals? Toshiba, it's a global name. You had Takata with the airbags, Mitsubishi. So when you're dealing with a world-class company and you have one financial or data scandal after another, how do you pour over which one is a good one, good egg?
Well, that's why you have a good fund manager. Sorry, I couldn't let that one go. No, but it's true. When you look at the companies bottom up, you actually spot these things, you see. And part of the reason I had the marching team was the stereotype, because it's very easy to stereotype on one or two events. Now, for example, talking about financials again, you've got Mitsubishi UFG, which of course has now bought Bank of UDA, or a portion in Bank of UDA, Bank Danamon. It's expanding around the region. You look at some of the Japanese car companies, where their expansion has gone into the States and into China. So you've got all of these developments that are happening and have been held back because of the scandals that you mentioned, and rightly so. The scandals, that is, not the other.
If everybody gets the memo from an economist perspective, is it actually both a blessing and a curse for Robert? Because all of a sudden, the Bank of Japan is faced with its influx of liquidity, and will that force them to tighten? In fact, get on a more normal pattern and wean off QE? And join the normalization parade that you see around the world?
Well, there's always, you see what happens here is there's a convergence. Just how somebody mentioned about convergence of these central banks. So now, earlier today, we had Malaysia Central Bank hiking interest rate. And also last year, we had Bank of Korea hiking interest rate. So what is happening right now is that the Fed took the lead 2 years ago, and now all the other central banks, including ECB, wanting to go on to the so-called normalization path, and Japan as well, right, is inching towards that of this is a bias, so-called towards tightening or maybe less accommodation. Okay, so now the trend is for all these central banks to move on to the same path. So it won't be surprising that Japan might have to do some similar. Bank of Japan might have to do something similar as well. The reason why all these central banks, you go back to the environment that we are in right now. These central banks quite comfortable with what they are seeing. You know, there's a growth, expansion, and things are getting a bit better, so they're more comfortable in continue to high interest rates and to tighten policy. And then we'll go into the risks that you mentioned earlier. What kind of risks we could see down the road? Okay, I'll leave it later.
Abel, does this mean that investors actually need to start repricing their expectations for 2018?
No, definitely. I mean, it'd be dangerous if you expect the same performance in as per 2017 in practically all the asset classes. Yes, asset prices do look cheap in certain areas, and we continue to like them. But over time, market's exuberance can actually push valuations a little bit too high, and that's when you actually start to consider diversification across different assets and actually possibly even taking money off the red hot table and identifying the ones that were formerly unloved and with very strong fundamentals.
We only have about 9 minutes left. Some great parting shots, takeaway advice for our audience. So, Jeff, I read that when you first moved over to Asia in the late 1990s, right, 1997, and you started covering Asian equities from year 2000.
Yep.
Back then, you found dirt cheap valuations. We're talking about PE ratios of 2 times, below book value, 0.XX. Dividend yields of 10%, and so on. Today, you can't find, it's nearly impossible to find such super deals. So how and where do you identify value when you look at Asian companies?
I mean, 2000 was extreme because it was an effect of the Asia crisis and the fact that many stocks were getting ignored. Don't forget, 2 years ago, there was very extreme value available in Asian equities as well. You know, the whole market was on 2 standard deviations cheap, and there were many stocks that were really on their knees. So we're not there now. We're back at average. Average is okay. Average valuations, to me, suggest average returns. There's still stocks out there that are relatively good value. I think you know, talking about QE, QE is peaking. The direction of change is there's going to be less of it in the future than there's been in the past. The exact pace of it, nobody knows, because it depends what economies do, yeah? Central bankers are data dependent. But it would appear that QE is going to start unwinding. Several asset classes have been major beneficiaries of this, bonds and bond-like equities, and others have suffered, because low interest rates has been very, very negative for many companies, particularly financials. So what I would do is look at the areas that are still relatively good value, that are beneficiaries of the next move, and be careful about things that have been beneficiaries of the last 5, 10, and 20-year developments.
And is it worth talking about the specter of recession? Because at the end of the day, we've been so rosy, the mood has been so harmonious among the panel. But is there any reason to fear that there could be recession because, for instance, if it gets a little bit too hot, that stokes inflation, the yields start backing up, and especially buyers in Asia don't want to buy US Treasury yields anymore, that it's a confluence of factors that could ultimately change the macro environment. Robert, is that something that you see, or even Tech-In for that matter?
No, we think about this all the time. You see, the problem with US Treasuries, say, for example, yes, the yields are low, but on Euro bonds and JGB 10-year bonds, you're getting yields, negative yields. So every Japanese and European pension fund in the world is wanting to buy Treasuries. Will inflation take off? Well, one of the major effects of the demographic change is that the overwhelming bulk of the jobs until recently in the US have been for over 55-year-olds. The number of 68-year-olds and over, 68 and over, working has gone from about 5% to 15% in the last 10 years. So it's very hard to see any inflation out there. So, and I think this is why we all have difficulties in trying to spot where is the gremlin going to come from. And I suspect it could be something either the central banks take a misstep and that liquidity is punctured, which I don't believe will be the case because the Fed has already indicated it will pump more money in, or it will be something like the derivatives out there. There's still a lot of off-balance sheet debt building up. There's still a lot of derivatives building up. On some measures, they're now higher than they were before the crisis. So it will be something like that, I suspect, that causes the torpedo. But the traditional targets, very difficult to make a convincing case.
I just want to go back to the point about just now, what kind of risks or gremlins might be out there. Maybe the policy error is part of the concern, part of the risk that could pop up down the road. Because let's say central banks are converging towards less accommodation, a bit of tightening, and then more of it at the margin, and everybody's doing the same thing at the same time. And then as a result, some might have or might do more than the rest and trigger some kind of downward spiral somewhere in terms of prices or whatever that develop into a herd instinct in the rest of other markets. So there's always a possibility of a policy error. Because right now the central banks are all moving, converging, doing the same thing, similar thing at the same time.
Actually, Chloe, could I add
yes,
on
yes.
that? Because I want to, at this point, draw a distinction between the other central banks and the Bank of Japan. Whether the Bank of Japan is starting on a tightening path is still out at the moment. In fact, it's very dubious, in my opinion, because the Bank of Japan is controlling the 0% yield on the 10-year bond, which means that if others are buying 10 years, then the Bank of Japan will buy less. And if others are selling, if inflationary expectations rise, and other people are selling or not buying JGBs 10 years, then the Bank of Japan has got to buy more. So all of these concerns over the last couple of months, I think they're more born out of extrapolation from what the Fed and the Bank of England and the European Central Bank are doing, rather than the Bank of Japan itself. So at the moment, and certainly as of last Tuesday, the Bank of Japan has got its foot still hard on the monetary accelerator.
Right, and I also wanted to pick up on that. The fact that even in Japan, you've got the JASDAQ totally on fire while the Nikkei has been lukewarm. And over in Davos, where a lot of discussions are taking place, this feature about the fourth industrial revolution is taking center stage. Now, Jeffrey, as an equity manager, equity portfolio manager, and a big fund manager, do some of the discussions, some of the changes underway in AI robotics, have they affected your equity strategy? Because if you look at some of the new developments, the retreat of GE, something for us to think about. The almighty GE actually retreating, is that a one-off or is that a changing of the guard? Or something else, for example, Goldman Sachs, the recent earnings, the stock may be at an all-time high, but that they're not doing God's work like they used to. Again, is this changing of the times or just a one-off? So as an equity strategist, an equity expert, have some of these news flows affected how you treat companies and their earnings news?
Absolutely. I think you have to look at the world as it is today and also project forward as to the way you think it'll change. Robotics is a huge thing in China, for example. I've been visiting Chinese companies for about 30 years or so. And when I first started doing it, they were ex-Soviet era factories. Companies like Haier were around in those days. I go back to those same factories today. They're full of robots. And they're not that different from their Korean and Japanese counterparts, maybe a few years behind, but catching up rapidly. If you look at the amount of money being poured into AI, there are two places in the world which are far ahead of everybody else. There's Silicon Valley and there's China. Right? And these are happening in listed companies like Baidu, for example. Right? Back to robotics again. Germany's biggest robotics maker, KUKA, was bought by a Chinese company last year. Right? So the emerging market countries are getting very much into AI. They seriously intend to leapfrog. And AI and robotics is one area where they believe they can leapfrog. Right? So these developments, they matter a lot. Right? Another place is electric vehicles. The Chinese companies realize they're never going to catch up with Germany in internal combustion engines, but they hope that they will leapfrog in electric vehicles. So we have to keep an eye on these technologies. We look at every company. We don't look backwards, we look forwards, and technology is a key part of that. Yeah.
And just quickly, a quick takeaway advice for our audience. What is the first thing that they should do tomorrow morning when they get to work? Or when they're sitting in front of their laptop? Okay, let's begin with you, Tech-In.
Okay, very quick. Just now I mentioned the currency, so I will stick to the currency. It's a soft dollar. So what you should do tomorrow, look at our report and go into Aussie dollar. Okay? So end of the year, you're going to have very nice return if our projection pans out. You're going to have a very nice return. So
okay.
Aussie dollar.
Look at the Aussie dollar pair.
Yes.
Okay.
Right. I certainly would not get Japan confused with the US market, which seems to be the case. I would try and de-link that break. I would look at what's actually happening at the corporate level, and I would start to add some Japan to my portfolio.
And when in doubt, ask you, right?
And exactly. And accumulate. Accumulate and wait. Yep.
Okay, Jeff.
Don't go all in on emerging market equities, yeah? Which is a phrase you used. My presentation was about balance, and I think there's plenty of asset classes you want some exposure to that will make your portfolio perform in a variety of environments. We do not know what will happen. We don't know whether QE will be reversed. We don't know whether US inflation will pick up. Yeah? We don't know whether the Chinese economy will be resilient. We like to pretend we have some opinions on these things, but we don't know exactly what will happen. Nobody has perfect foresight. You need to build a portfolio that will react well or badly to all environments and make your money over time.
Now, staying nimble, being flexible to the changes. Thank you. And Jeffrey?
Call your client advisor first thing in the morning and check your equity exposure. We believe in this part of the cycle you should be above average in equity exposure, although I totally agree with the diversification. It's the only free lunch that's out there. Diversified, but at this point in time, overweight in equities.
Right, ready to pivot, but go all in for the time being. And Abel?
Well, clearly, diversification is actually the key message that I think the panel really wants to get across to you. But there's no harm taking money off an expensive bet and diversifying into something which offers you some significant value, because 17 was a spectacular year. Expecting the same result in 17, I'm not too sure this is a realistic expectation. Don't overextend yourself in terms of risk, focus on your long-term goals, and stick by the plan.
Ladies and gentlemen, our wonderful panel, and thank you so much for being with us tonight. Thank you so much.
Brought to you by UOB Privilege Banking.